Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
John, first of all, let's take a look at the U.S.-China trade talks. First, we're told, we have a Phase 1 agreement. Then the Chinese say, hold it, we want to talk a little more before we sign anything. Is this kind of a sign of what's going on? It sounds like good news, but it really isn't.
Well, this is how negotiations go, because neither one of these guys wants to lose face by not succeeding, and they both have really important goals in this trade dispute. You know, the U.S., China has basically been sucking us dry of our manufacturing base, and we're suffering for it now. You know, a big part of the income and wealth disparity in the U.S., which has reached, 1929 proportions, pre-depression proportions, is due to the fact that all of our manufacturing jobs are flowing overseas, which is basically eviscerating labor unions in the U.S. And labor unions were how high school educated people got good money back in the day, and that's not the case anymore. So if you're a 40-year-old white guy with a college or a high school education, there's very little for you in America right now that allows you to even help support a family. And that, led to the election of Donald Trump, which has led to the trade war. So we have a point. Trump has a point in wanting what he wants from China. And China, of course, has a point in wanting to keep what they've gained in global trade over the past few years. So it's not going to be easy. But they're both suffering now from the trade war. We are both suffering. The U.S. economy is slowing down. China's economy is really rocky right now. It's got issues with its shadow banking system, and its car sales are plunging, and it can't afford a recession because it's got hundreds of millions of people that have upwardly mobile expectations right now. So anyhow, it's going to be messy. But the markets reacted well to the announcement that Phase 1 of the trade deal was signed, sealed, and delivered. And it didn't turn out to be true, but still, the stock markets like that there's progress. But the important thing to understand with all this is that it's not meaningful in the long run. And there's a lot of other news like that out there that's coming that will goose the markets temporarily, but none of it is very meaningful. For instance, the Fed is going to cut interest rates a couple more times, and they're starting a QE program that's not really QE, but they're pumping money into the banking system. Those things are not meaningful from the standpoint of our financial survival in the developed world, because we've already taken on so much debt that none of the rest of this stuff is going to matter. The government can run a big deficit to try to generate growth. Okay, that works a little bit in the very short term. The Fed can cut interest rates from here, but interest rates are already historically low. If the Keynesian models that most economists are operating with right now had any validity, then a 0% Fed funds rate and a 1 or 2% Treasury bond rate would have produced a rip-roaring economy in the U.S., just an expansion, the likes of which we've never seen before, because that's extremely easy money. And it hasn't worked. And negative interest rates haven't worked in Europe, where Germany might be in recession right now. And in Japan, where growth is very slow and inflation is still below target, even though interest rates are negative. Don't expect that to work in the U.S., because beyond a certain point, the benefits of lower interest rates diminish dramatically, apparently. So we'll see that here too. So that's not awesome news. And, the trade war, when it gets settled, which it will when these guys are tired of the pain that they're feeling, when it gets settled, it's not going to be that big of a deal. Our manufacturing base is pretty much emptied out, and we might be able to bring a few jobs home in the U.S., but a lot of those jobs will just never exist anywhere going forward because of automation. And China has borrowed so much money that even if they get a favorable trade deal from the U.S., they've still got to deal with the consequences of having quintupled their debt over the past 10 years and created a really fragile financial system that they can't take on a lot more debt in order to grow. So we're still a mess. But we kind of have to get past these fake pieces of good news to realize just how bad and how too far gone we are financially. So the next year ought to be really choppy as good news comes out and the markets jump, and then in between the good news, the markets realize that things aren't so good after all, and stocks tank, et cetera, et cetera. Until we come to the conclusion that the guys in charge have no tools left with which to fix anything. And all the news, therefore, going forward is bad news. And that's out there. That's maybe a 2020 story and maybe a little bit beyond that, but I don't think much beyond that. The wild card in the U.S. is that there's a presidential election. And the government always goes all out during a presidential campaign to get the incumbent party reelected, which means they will spend insane amounts of money to placate the important constituencies out there. And, in Trump's case, that means probably a big infrastructure spending program and probably job-owning the Fed to cut interest rates much further than it would have otherwise. And it's hard to say what that does in the short run, but I can say with a high degree of certainty that it won't do much in the long run. We're already too far gone. And beyond a certain point, interest rates won't save us, government spending won't save us because it's borrowed, really, right? When the government runs a deficit to spend money on roads or bridges or the military or tax cuts or anything, they have to pay that debt back at some point. So we really didn't gain anything in the long run. We just pulled future spending into the present at the expense of what happens in 2 or 3 years. So that's where we are. It's very ambiguous based on the headlines, but the underlying fundamentals are terrible and getting worse.
We'll have more with John Rubino right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with John Rubino. John, both the U.S. and Canadian governments ran up huge deficits in what people were calling relatively good times. What's it going to look like if there's a recession?
Oh, deficits will explode. That's one of the strange things. Although, it's predictable on one hand, because once you borrow too much money, you have no choice but to keep borrowing more and more money to keep the old debt from collapsing. So you would expect us to be running big deficits. On the other hand, this late in a business cycle, in other words, years and years and years into an expansion, governments normally have pretty good cash flow because everybody who can hold a job is at work. They're all paying taxes. Governments are getting a lot of tax revenue, and usually budget deficits either shrink dramatically or go all the way into surplus. at this point in the business cycle. And the fact that we're increasing our government spending, and we're in the U.S. running $1 trillion annual deficits now, kind of implies that when the next recession comes, we'll be running $2 or $3 trillion deficits. And again, uncharted territory, no way to know what that means, but the numbers are so huge that they seem catastrophic when you apply a little common sense to, what the total government debt will be and what our interest costs will be if interest rates ever go back to normal. The implication is that we can never raise interest rates back to normal again. So we have to live with the distortions of super low interest rates basically forever, or until the system breaks down, which will be much sooner than forever. But that's what we have to look forward to in the next recession. Much lower interest rates, probably negative interest rates in the U.S. I'm not sure about Canada, but you guys could go negative too very easily. If the U.S., Europe, and Japan all have negative interest rates, wouldn't be a surprise to see Canada and the U.K. with their own negative interest rates. And massive, massive government deficits, which will show no sign of ever shrinking again. Once they go up to $2 or $3 trillion in the next recession, in the U.S., it's hard to see how we ever get back to, $400 billion deficits annually. That'll just never happen again. And for the markets, the question is, when do a critical mass of people figure this out and realize that we're basically done with any conception of a return to normality? That is over, and we have to live with what we've got now. And what we've got now is unsustainable. So if we can't fix it, and we can't stop it, and it will inevitably blow up if we keep going in that direction, what do we do? And that's the question that everybody's going to be confronted with at a not too distant future, a certain point in the not too distant future. So this comes back then to precious metals. Because where do you hide out in a world where governments have no choice but to dramatically devalue their currencies to try to get out from under a mountain of debt that they've taken on? And historically, gold and silver were one of the places. So gold is extremely cheap compared to its fundamentals and compared to probably what's happening in the future. Silver is extremely cheap relative to gold, and when it's been this cheap relative to gold in the past, it has gone up dramatically faster than gold has. So the situation is set up very nicely for silver, I think, and for those stocks of the companies that mine silver, of which there aren't too many. There are only a handful of high-quality silver miners out there, and they're probably going to do really well. So that's the quickie investment thesis that flows from all this. You want to get your money out of financial assets that depend on the value of the currency that those financial assets pay you, and into things like gold and silver and really well-chosen real estate and maybe some energy assets, which governments can't create more of. Therefore, their scarcity allows them to go up in local currency terms. In other words, when the currency is plunging in value, those things real assets will hold their value, which means they'll go up in local currency terms. So, this is turning into an almost guaranteed kind of thing, and it's just a question of timing now. How long does this take? Because people are starting to figure it out. You're seeing the markets get extremely volatile whenever central banks even talk about stopping their easing, and let alone tightening. The U.S. tightened just briefly in 2018, and the stock markets tanked at the end of 2018. So now we've got easing of a sort from the Fed. And when that doesn't work, it'll be just blatant, flat out, pedal to the metal, whatever it takes, monetary ease, and without end. And so people will be looking around for what does well in those kinds of circumstances. And you would expect a lot of capital to flow into real assets. Now, that's how you protect your own personal finances from something like this. But the kind of world in which gold is $5,000 or $10,000 an ounce and oil is $200 or $300 a barrel, that's not a nice world. So it would be good for most people to start thinking about how to structure not just their finances, but their lives for extreme instability. And that's subject for a longer conversation than we have right now. But the whole, survivalism light thing, not full on cabin in the woods with a shotgun kind of stuff, which it might or might not be a good idea at some point in the future. But for most people, that's too big of a leap from the current mindset. But you know what? Get a generator and start trying to make as many connections in your community as possible, because friends who are available to help when things get crazy are worth their weight in gold and then some. You really want to be part of a community of people who are there to help each other when things get very uncertain. And by uncertain, I mean, businesses failing and throwing a lot of people out of work because the financial markets are so unstable, and the supply chain for basic necessities being a little bit messed up for a while, depending on where you are. If you're in a city, that's a very big possibility. If you're out in the country, not so much. But still, and then you want to try to make yourself as indispensable at work as possible. Don't just show up and do your 8 hours and then go home thinking that is guaranteeing you a job no matter what. Go in and figure out what the people running the company need more than anything else, and do your best to supply those things. In other words, make life easy for the people who get to decide who gets laid off and who don't get laid off, who doesn't get laid off when the time comes. And if you do all that, you're taking steps. It doesn't guarantee anything in a world that is really volatile and uncertain, but you skew the odds a little further in your favor by doing stuff like that. And that's all, by the way, things you should be doing in normal life anyhow. You really should be connecting yourself to your community and making yourself indispensable at work. That's basic common sense, but it's stuff that we overlook in good times because we feel cocky. Like we don't really need help, and we don't really need security because the system is giving those things to us. But in a world where the system doesn't do such a good job of giving those things to us anymore, we have to make it happen for ourselves. And that's what people should be thinking of right now.
We'll have more with John Rubino right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with John Rubino. John, you mentioned Canada, the U.S., the U.K. could go to negative interest rates. What would that do to pension funds, which are already hard-pressed to meet the demands for cash?
It would be catastrophic for pension funds. Because what a pension fund is, it's an investment fund. That, say you're a teacher, and you pay into that fund, and they promise to give you X amount of money per month, plus some health care or whatever, when you retire. And they know how much that's going to cost, more or less. So they know how much money they need to make good on those promises. And they know how much they have to earn on their investment in order to have that money. Part of their investments are going to be in fixed income, that is bonds. And they expect that bond portfolio to earn a certain amount. And usually it's 5 or 6 or 7 or 8%. Now, with bonds yielding 2% all the way down to negative numbers in the developed world, there's no way pension funds can earn that. So the further down interest rates go, the harder it becomes for pension funds to fund their promises. And the more likely you are as that teacher who's been paying in and playing by the rules, doing what you're supposed to do, to get paid later on. Now, lots of people are retiring now, which means this is going from a balance sheet issue that's easy to hide to a cash flow issue which cannot be hidden for a lot of pension funds. So it's bad now, And if interest rates go down further from here, it'll be worse for them. And a lot of pension funds will just start blowing up. So a lot of unionized public sector employees like teachers and cops and firefighters and people who really don't deserve to suffer because they've already done good work for an entire career, they will be the ones who suffer from this because they're going to have their pension plans cut dramatically. In other words, if you thought you were going to get $2,000 a month, maybe you're going to get $1,100 a month going forward in reality. And that means that you are not nearly as well off as you thought you were.
John, I recall Draghi, just before he finished up as chair of the European Central Bank, said pension funds are going to be in trouble because of negative interest rates. And then the very last thing he did while he was in charge was lower interest rates once again into further into the negative. What kind of a message does that tell us about the people who so-called are in charge?
Well, what it means is they understand what the problem is, and they know they have to continue to cut interest rates no matter what, despite the fact that it's going to do a huge amount of damage. It's a lesser of evil thing for these guys at this point. They're just trying to keep it going for the next 6 months or a year before the system blows up. And the fact that pension funds are going to blow up over the next 2, 3, 4, 5, 6 years is less of an immediate problem for them. So they have to do what they have to do right now to keep us from tipping into a recession, which could become a depression, which could pretty much end the global financial system. So pensioners are collateral damage in all this. But they're not going to take this sitting down, so they're going to be voting for, fringe candidates who promise to fix it. And then when those guys get into office, the policies won't be coherent, and, political life will get even more chaotic as part of this, which will flow back into finance, which will flow back into politics, until you have this descent into really complete chaos. That's what happens when you borrow too much money. It sounds crazy, but borrowing too much money leads to crazy things happening. Look at the 1920s, which is the last time we took on anything like this kind of debt. No, we didn't take on nearly as much debt back then as we have now, but it was enough to blow up the global financial system for, a decade of really, really hard times. We've done worse things now financially. Therefore, the problems that are going to flow from this might be commensurately worse. Doug Casey, a major name in the precious metals community, talks about the Greater Depression. In other words, the depression that's coming that's going to be worse than the 1930s because we borrowed so much more money than we borrowed in the 1930s. So here we are. There's an investment thesis that helps, and there are things you can do to protect yourself, but there's nothing you can do to stop the big systems from breaking down at some point in the not too distant future.
Does this mean you should be out buying gold and silver coins right now?
Oh yeah. Yeah, that's one of the things you can do financially to help yourself. So just be a stacker. Don't dump everything you have into any investment in the short run here. But over time, buy some gold and silver, a little bit each month. That's all you really should be doing. I mean, you can try to time the market, but that's a very difficult thing to do and sets you up for a big short-term loss, even if there's a long-term gain at the end of it. But if you dollar cost average, if you buy a certain amount of precious metals each month and then just put them away and don't think about them and get on with your life, at the end of the process, you'll have a nest egg that is up in value in local currency terms and will allow you to protect yourself. And that's financially the best and most straightforward thing that anybody should be doing right now.
Is it surprising if gold and silver are going to be the future that junior miners are still struggling right now? Wouldn't they be the first to benefit from this?
No, they're not the first. They're fairly risky and not well understood. So when gold and silver go up, what happens first is that the big miners, like if you just call your broker and say, hey, I see gold going up, get me into a gold mining stock. That broker's not going to go, oh, I see this little junior with a $200 million market cap that nobody's ever heard of. I'm going to put you in that. No, they'll go, okay, let's get you some GDX or some Royal Gold or some Franco-Nevada. In other words, they'll pull up the big brand name gold miners that they have heard of. Because remember, your broker has also never heard of these junior miners either. And then the process begins there with those miners going up, with the big ones going up, and then people looking around going, well, what else is there that I can buy in this space? And then they go to the mid-tier miners, and those things go up, and then people say, well, what else? And, oh, look at these juniors. They're so cheap. You know, if that is valued the same way that this big company is, then, whoa, look out. And then money starts pouring into the junior miner space, and everything goes up. Good companies, bad companies, doesn't matter. If you're a junior miner, it's like you're a .com back in 1999. People just buy it because of the label. And that is out there waiting to happen. I would say when gold hits 2,000 US dollars per ounce, you will see the junior miners just take off like a rocket. They will have been rising prior to that, but they'll go parabolic when gold hits a big record high number like 2,000. And that could easily be a 2020 story. You know, it could be something that happens next year very easily. Because remember, with gold now, we've got seasonality working in its favor. And normally, January is a great month for gold, and February is a pretty good month for gold. So if we start here and have a great month in January and a pretty good month in February, that implies we get close to 2,000 US dollars an ounce. So we should see the miners respond accordingly. And right now, there are a lot of extremely cheap juniors out there. So it wouldn't be a bad time to be nibbling at them right now, but you wouldn't expect them to take off immediately when you buy them. But it's probably a good time to get some cheap if you want.
If real assets like gold and silver are to become king, what happens to cryptocurrencies? Well,
cryptos are a story that I frankly don't understand in terms of how they trade. You know, why did Bitcoin go from $200 to 15,000, and then why did it go back down to 3,000, and why is it up to 8,000 now? I just don't know. I don't understand that dynamic, and a lot of people claim they do, but I'm not sure anybody really does. Cryptos are a great conceptual idea. You know, private sector money that's technology based, that exists outside the regulatory financial structure, and doesn't depend on governments keeping promises for them to hold their back. You know, that's all great stuff. But on the other hand, there are an awful lot of cryptos being created, and something like Bitcoin, which is the big brand name cryptocurrency, while its supply is limited by the algorithm that controls the creation of the new Bitcoin, they do this thing called forking or halving, and where they just split a new kind of Bitcoin off the existing Bitcoin system, and then start increasing the supply of that new Bitcoin. And so you combine that with all the other cryptos that are being created, and you can't really say that the supply of cryptos as a universe is limited. And the fact that the supply of cryptos in general is basically unlimited means that it's hard to say that there's a fundamental value there for cryptos in general. Some cryptos will succeed, I think, when the big shakeout comes. Just like some .coms ended up becoming big, powerful companies like Amazon after the 2000 crash in the .com stocks, when most of them went out of business. So I don't have the expertise to say anything with certainty about the role cryptos are going to play in the future financial system. But I think they will play a role. I just don't know what it is, and I don't know how you profit from it. So you've got to ask a much more sophisticated crypto person than I am about this, and hopefully they can give your listeners a roadmap to follow vis-a-vis cryptos. But I think it's definitely worth educating yourself about them and worth having some in your overall portfolio at some point. But I don't know which ones, and I don't know how to go about choosing.
Well, if the electrical grid is a victim of economic collapse, good luck accessing your cryptos. Whereas your gold and silver might just be buried in the backyard.
Well, see, that's the thing about gold and silver is that nobody else has to keep a promise. Nobody else has to do anything for those things, for gold and silver to have value. So you don't need the banks to operate happily and consistently. You don't need governments to control the value of their currencies. You don't need any of that stuff with gold and silver. It's just what it is. No counterparty risk. And if you have a cryptocurrency that is in an exchange online and the internet gets choppy, then you've got issues. And if you look at the countries where they're having hyperinflations now, like Argentina and Brazil, and you see that the electric grid is one of the victims, and the internet is not as reliable as it used to be, and so that's in the extreme version, worst case scenario financial crisis that might easily come, since we're making the same mistakes that Argentina and Venezuela have made. Then online assets are not liquid and not easily accessible necessarily. So your brokerage account, your online bank account, et cetera, might be hard to get to, which is why you want the money on hand. Even local currency cash is a good thing to have in the short run because it's very liquid at least. You can spend it. It may not be on favorable terms, but people will definitely take it until the very end. And the same thing with gold and silver. If you're in Venezuela right now and you've got some silver coins, you have real money. You can take those silver coins out there and you can trade those things for stuff that you need. And the same thing will be true here. If you have silver coins, you can take them out right now and you can give them to people in return for stuff. And the time will come when you can give them to people for a lot more stuff than now. So you want stuff like that. And again, I'm not painting a Mad Max scenario, and I don't think that's a highly likely scenario, but I do think that things will get messy, and messy can mean a lot of things, and we don't know exactly how this will play out, but it might be the kind of world, even in the developed world like the U.S. and Canada, where it's good to have some cash on hand, and it's good for that cash to be gold and silver rather than all dollar. Just because you can't trust the government to maintain the value of the dollar, and the government cannot lower the value of gold and silver in the long run. So you want to have the thing that the government can't mess with when the government gets really desperate and crazy. And that would be gold and silver.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. His website, dollarcollapse.com. If you have any questions for John or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.